Have you ever wondered what happens when money just stops moving? Let's talk about the time the silver market froze solid. Imagine this. Suddenly, nobody trusts anyone else's money. Banks won't lend to each other, businesses can't get loans, and everyday people find their savings are stuck. This is a credit crisis. The silver market once faced this exact scenario. Speculation ran wild, prices shot up, and then crashed spectacularly. The result? A massive freeze. Trust evaporated, and the flow of money seized up, causing widespread financial chaos. What's going on with the world of precious metals? It feels like one minute everything's booming, and the next, there's a sudden halt. Let us talk about the big mystery from the surface event. Why did refiners suddenly stop buying? If you're in the industry, or even just watching from the sidelines, this is a puzzle you'll want to solve with me. So, picture this. The surface event is in full swing. When a refiner says they've stopped buying gold, what do they really mean? It's rarely about a lack of physical demand. Instead, the real story is about credit. The entire flow of precious metals from mine to mint isn't powered by cash on hand, but by a complex web of credit. Think about it like this. A refiner buys scrap gold today. They melt it, purify it, and form it into new bars or grains. This whole process takes time. Then, they have to sell that refined product to a customer, like a mint or a jewelry manufacturer. That customer might take 30 or even 60 days to pay. So, from the moment the refiner buys the raw metal to the moment they get paid for the finished product, there's a huge time gap. During this entire period, the value of that metal sits on the refiner's balance sheet as inventory. They've paid for it, but they haven't been paid yet. This is where the banks come in. Banks provide the credit lines that allow refiners to carry these massive inventory costs. Without this financing, the system would grind to a halt. So, when you hear a refiner say, "We're not buying," it's often a coded message. What they're really saying is, "Our bank won't allow us to expand our balance sheet any further." They've hit their credit limit. The decision to buy or not to buy isn't driven by market sentiment, but by the cold, hard numbers on a banker's spreadsheet. It's a crucial reminder that in the world of precious metals, credit is king. It's one of the biggest gatherings for anyone dealing with precious metals. Miners, refiners, traders, you name it. The energy is usually electric. Deals are being made left and right. But this year, something was different. A strange quiet fell over the refining sector. The big players, the ones who are usually the most active buyers, suddenly hit the brakes. Why? The first piece of the puzzle is the soaring price of gold. When gold skyrockets, it creates a lot of volatility. For refiners, their business is all about margins. They buy raw material like scrap jewelry or unrefined gold bars and process it into pure gold. Their profit is the difference between what they pay for the raw material and the spot price of gold when they sell, minus their operational costs. When the market is this unpredictable, that margin becomes razor thin and incredibly risky. A sudden price drop could wipe out their profits in an instant. So, many decided to step back and wait for the market to stabilize rather than gamble on such a volatile price. Next, let's talk about supply chain chaos. This isn't just a post-pandemic headache anymore. It's the new normal. For refiners, getting a consistent and reliable supply of unrefined gold is everything. But with geopolitical tensions, changing regulations, and logistical nightmares, that supply chain is more fragile than ever. At the event, there were whispers about major disruptions in key mining regions. If you can't be sure you'll get the raw materials you need, it's pretty hard to commit to buying. The risk of paying for something that might get stuck in transit or delayed indefinitely is just too high. So, many refiners opted to pause their purchasing to reassess their supply sources and wait for more clarity. Then there's the regulatory elephant in the room. Governments worldwide are cracking down on the origins of precious metals to combat illegal mining and unethical sourcing. This is a good thing, of course, but it adds a massive layer of complexity for refiners. The paperwork, the due diligence, the constant need to prove that every ounce of gold is ethically sourced, it's a huge operational burden. At the surface event, there was a lot of discussion about new, stricter regulations on the horizon. This uncertainty makes planning for the future incredibly difficult. Instead of getting caught in a potential compliance nightmare, many refiners chose to hold off on new purchases until the regulatory landscape becomes clearer. It's a classic case of better safe than sorry. Finally, we can't ignore the economic forecast. With talk of a global recession, rising interest rates, and inflation, consumer demand for things like jewelry and investment gold could take a hit. Refiners are at the mercy of this end market demand. If they ramp up production but no one is buying the final product, they're left holding a lot of very expensive inventory. Seeing these economic storm clouds gathering, many refiners decided it was a prudent time to be cautious. They slowed down their buying to avoid getting overextended in what could be a challenging economic period ahead. So, putting it all together, it wasn't one single thing that caused refiners to stop buying at the surface event. It was a perfect storm of high prices, supply chain instability, regulatory pressure, and economic uncertainty. They weren't panicking. They were being strategic. They hit the pause button to manage their risk and wait for the waters to calm. It's a fascinating look at how global forces can ripple through an entire industry in real time. What do you think will happen next? Will they jump back in, or is this the start of a longer trend? Have you ever wondered what keeps the world running? It's not just oil, but something much less visible: credit. Today, we're diving deep into the surprisingly fragile world of oil refining and uncovering how the entire system, from the barrel of crude to the gas in your car, is built on a foundation of borrowed money. It's a hidden financial machine, and when it sputters, the whole world feels it. Let's start by looking at a refinery not as a maze of pipes and towers, but as a business with a balance sheet. On the asset side, you have the obvious things: the physical plant, the machinery, and vast storage tanks. But their most critical assets are constantly in motion. A large refinery can hold millions of barrels of crude oil as inventory, which is an asset worth hundreds of millions of dollars. Once processed, this becomes another asset: gasoline, diesel, and jet fuel waiting to be sold. And of course, there's cash on hand to pay for daily operations. But here's the other side of the ledger: the liabilities. Very few refineries own all that crude oil outright. They buy it on credit, meaning it shows up as accounts payable, a short-term debt they owe to oil producers. Then there's the big one: long-term debt. Building or upgrading a refinery costs billions, and that money is almost always borrowed from banks. These loans are massive liabilities on their balance sheet. So a refinery is constantly juggling a huge pile of assets, mostly oil, against an equally huge pile of debt. The game is to sell the refined products for more than the crude cost, plus interest, before those debts come due. This is where things get really interesting, because the price of oil is anything but stable. Imagine a refinery buys 1 million barrels of crude at $80 a barrel, planning to refine and sell it in 3 months. That's an $80 million inventory asset. But what if, in those 3 months, the global price of oil crashes to $50 a barrel? Suddenly, their $80 million asset is only worth $50 million. At the same time, the price of the gasoline and diesel they produce will also plummet. They could be forced to sell their products for less than they paid for the raw crude, leading to a catastrophic loss. To protect against this, refineries use a financial tool called hedging. It's like buying insurance against price swings. Here's a simplified example. The refinery buys that same 1 million barrels of crude for future delivery. Simultaneously, they go to the futures market and sell a futures contract for 1 million barrels of crude at today's price of $80. Now, watch what happens. If the price of oil crashes to $50, they lose $30 million on their physical oil inventory. But their futures contract becomes profitable. They can now buy back that contract at the new, lower price, making a $30 million profit. The profit from the hedge cancels out the loss on the physical oil. This protects their profit margin, but it comes with its own risks. To maintain that futures position, the refinery needs to post collateral, known as margin, with an exchange. If the price of oil goes up instead of down, they start losing money on their hedge. The exchange will then issue a margin call, demanding more cash immediately to cover the potential losses. This is where credit becomes absolutely vital. Refineries don't just keep hundreds of millions in cash lying around for margin calls. They rely on pre-arranged credit lines with banks, often called revolving credit facilities. These are like giant corporate credit cards that allow them to draw cash instantly to meet margin calls and manage their daily cash flow. Without these credit lines, a sudden price spike could bankrupt a refinery, even though the value of their physical oil is increasing. We saw this system break down spectacularly during the 2008 financial crisis. When Lehman Brothers collapsed, the credit markets froze. Banks, terrified of risk, stopped lending to each other and to corporations. Suddenly, refineries couldn't access the credit they needed to buy crude or meet margin calls. It didn't matter if they were profitable on paper. Without cash, they couldn't operate. Many had to slash production or shut down entirely, not because of a lack of oil, but a lack of credit. A similar, yet different crisis hit in 2020. The pandemic caused a historic collapse in demand for fuel. With planes grounded and people staying home, the world was drowning in oil. The price of crude famously went negative for a day, meaning producers were paying people to take their oil. For refineries, this was a nightmare. The value of their inventory evaporated overnight. At the same time, they couldn't sell their gasoline and diesel, causing their storage tanks to fill to the brim. They were stuck with expensive crude and finished products they couldn't move. Again, credit was their only lifeline to survive the shutdown and weather the storm until demand returned. So what does this all mean for you? When a refinery shuts down, the impact goes far beyond just higher prices at the pump. It creates a domino effect. First, the supply of specialized products like jet fuel, asphalt for roads, and the chemical building blocks for plastics, fertilizers, and pharmaceuticals tightens. This means air travel gets more expensive, road construction projects get delayed, and the cost of everything from your water bottle to life-saving medicines can increase. It also means job losses, not just at the refinery, but for the thousands of truck drivers, pipeline operators, and port workers who support it. A credit crunch in the financial world can lead to very real shortages and economic pain on Main Street. In the end, the global flow of energy is inextricably linked to the global flow of credit. The complex machinery of a refinery is mirrored by an equally complex financial machinery working in the background. Understanding this dependency reveals a fundamental vulnerability in our modern economy. The system that powers our cars, our homes, and our industries runs on a constant, uninterrupted supply of both oil and credit. When one falters, the other cannot function. The systemic layer. Why this is not isolated to silver. If this were only a silver story, it would not matter very much. A single market can have problems for many reasons. A factory can close, a regulation can change, a supply chain can shift. These things happen all the time, but this situation does not fit that pattern. What is happening in silver has the same shape as what has happened before in much larger crises. The details change, the structure does not. In 2008, the world did not run out of assets, it ran out of balance sheet. Banks did not stop lending because there were no good borrowers. They stopped because they could not carry any more risk. In 2020, the world did not suddenly lose ships, planes, or warehouses. It lost the ability to finance and coordinate them at speed. Each time, the first signs did not appear in stock markets or headlines. They appeared in the plumbing, in the short-term funding markets, in trade finance, in inventory lending, in margin rules. The silver refining problem fits exactly into this pattern. Commodity markets look physical, but they are not. They are financial systems that move physical things. Every step in the chain depends on credit. A miner finances production. A trader finances inventory. A shipper finances transport. A processor finances transformation. A buyer often finances purchase. At each step, a balance sheet is used as a bridge between time and delivery. When interest rates were low and money was easy, the system could expand without stress. Inventory could grow. Transit times could lengthen. Safety buffers could be built. Now the opposite is happening. Rates are higher. Collateral rules are tighter. Regulators are more cautious. Volatility is greater. And banks are more selective. Each change alone seems manageable. Together, they create a slow, silent contraction. The important thing to understand is this. The system does not need to collapse to start failing. It only needs to stop growing. A modern supply chain is built on the assumption that financing is always available. When that assumption breaks, the chain does not snap immediately. It stiffens, then it slows, then small frictions appear in unexpected places. A shipment is delayed, a quote is withdrawn, a limit is reached. At first, nobody connects these events. They look random. They are not. They are all symptoms of the same pressure. This is why paper markets can look calm while physical markets begin to seize. A futures price is just a number. It does not show whether anyone can actually move, store, process, or finance the real thing. In stressed systems, this gap grows. On screens, everything looks normal. In warehouses and back offices, everything becomes more careful. This is also how financially created shortages appear, not because goods do not exist, but because fewer players are able to carry them. When fewer balance sheets are available, less inventory can be held. When less inventory is held, buffers disappear. When buffers disappear, small disruptions become big problems. This is not unique to metals. It is already visible in parts of energy markets, shipping and logistics, agriculture, construction materials, industrial components. In each case, the story is similar. The world still has the stuff. It just has less capacity to finance the movement of the stuff. Maxed out credit is not a dramatic phrase. It is a technical condition. It means that a system has reached the point where it cannot grow without something else shrinking. And when that happens, markets start to behave in new ways. Instead of competing for opportunity, participants start competing for balance sheet space. They ask, which activities must we keep? Which ones can we pause? Which exposures are easiest to reduce? The least essential, or the most balance sheet intensive, are the first to go. That is why secondary silver is being refused. Not because it is risky, but because it uses space. The same logic is being applied quietly everywhere. This is also why these phases often confuse observers. People expect crises to be loud. They expect panic. They expect prices to move first. In reality, modern crises usually start with caution. They start with committees, with revised limits, with changed terms, with not at this time. By the time prices finally react, the internal decisions have been in place for months. This is the stage the system is in now. Not collapsing, but tightening, not breaking, but constricting. And in a highly leveraged, highly optimized global economy, constriction is enough to cause real damage. The refining story is just an early, visible crack, a place where the financial structure touches something physical and the stress becomes visible. It is not a special case. It is a preview. Because when a system built on constant credit expansion stops expanding, it must adjust. An adjustment in such systems is never smooth. It always shows up first in the quiet refusal to do business that once seemed normal. The strategic consequence. What this signals for the business. For most business owners, events like this are easy to ignore. A refinery refusing silver does not sound like something that should matter to a manufacturer, a trader, or a service company. It sounds distant, technical, someone else's problem. That is how these phases always begin. But the real message of this event is not about silver. It is about how the financial environment is changing for everyone. Modern businesses do not run only on customers and products. They run on credit. Inventory is financed. Equipment is financed. Transport is financed. Growth is financed. When credit is easy, this is invisible. It feels normal. It feels stable. When credit tightens, it becomes the most important variable in the entire system. The first places affected are always the middle layers of the economy, not consumers, not governments, but the companies that move, store, process, and distribute. These are the businesses that live on thin margins and large volumes. They survive by keeping things flowing. Now, when balance sheets become constrained, these businesses must change behavior. They carry less inventory. They take fewer risks. They shorten timelines. They become more selective about customers and suppliers. From the outside, this looks like being cautious. From the inside, it is survival. The dangerous part is that this change does not stay contained. It moves outward in stages. First, commodities and intermediaries feel it. Then logistics and inventory-heavy businesses. Then manufacturers. Then retailers. Finally, consumers and workers. By the time the last group notices, the process is already far advanced. This is why many economic slowdowns seem to come out of nowhere. They do not. They begin in places most people are not watching. Another important lesson is about the difference between availability and price. In textbooks, price moves first. In real systems under stress, availability often moves first. Things are still for sale in theory, but delivery times get longer. Conditions get stricter. Quantities get smaller. Then, suddenly, something that used to be easy to get is not. Only later does the price adjust. This is why businesses often misread these periods. They think they have a supply problem. In reality, they have a financing problem. The supplier cannot carry inventory. The distributor cannot extend terms. The transporter cannot get insurance or credit. The product exists. The system that moves it does not have enough balance sheet to function smoothly. For business leaders, this changes what matters. In expansion phases, strategy is about growth, market share, and efficiency. In contraction phases, strategy is about resilience, liquidity, and simplicity. The most valuable asset becomes not opportunity, but flexibility. Questions change. Instead of, how fast can we grow? They become, how long can we operate if conditions tighten further? Which parts of our business use the most working capital? Which dependencies are most fragile? Another uncomfortable truth is that many businesses discover too late that they are more leveraged to the system than they thought, not through debt, but through structure, through long supply chains, through just-in-time inventory, through reliance on continuous financing. All of these work beautifully when credit expands. All of them become vulnerabilities when it does not. The refining event is a warning because it shows something very specific. It shows that even boring, essential, low-risk activities can be paused when balance sheets are full. That should make every decision maker think. If a profitable refiner can say no to good business, who else will have to do the same? And what will that look like in other industries? The sensible response is not panic. It is preparation. It is understanding where the business is exposed to. Financing risk, inventory risk, counterparty risk, timing risk, and reducing those exposures before they are forced to be reduced. Periods like this also change who survives. Not the fastest, not the biggest, but the ones who can operate with less dependence on perfect conditions. The ones who can continue even when credit is tighter. Terms are worse. Volumes are lower. The refining story is not a forecast. It is a signal. A small early sign that the environment is shifting from expansion to constraint. History shows that these shifts do not reverse quickly. They move in waves, and each wave tests a different part of the economy. Those who recognize the change early can adapt. Those who ignore it usually learn about it when options are already limited. The refusal to buy silver is not the end of anything, but it may be the beginning of a more difficult phase, a phase where access to money matters more than ideas, and where survival depends less on ambition and more on balance sheet discipline. What does a major refinery refusing to accept silver for payment tell us? It's not about the silver itself, it's a huge red flag about credit. This is a classic sign of credit contraction, a financial tightening that sends shockwaves through the entire business world. Think of it like a ripple in a pond, starting with the big players and spreading outwards. First, it hits the intermediaries, the traders, the processors. They suddenly find their credit lines cut. They can no longer easily finance their operations or their inventory. The new winners will be those with strong balance sheets, those who prioritize liquidity and resilience over risky expansion. This credit crunch then flows down the supply chain. Manufacturers who rely on these intermediaries for raw materials face delays and price hikes. They might have orders to fill, but can't get the components they need. This is a supply chain crisis driven not by logistics, but by finance. For business leaders, this means immediately reevaluating your suppliers. Do they have the financial stability to weather this storm? You need to diversify your sources and maybe even consider bringing some production closer to home to reduce dependency. Finally, the wave hits the consumers. As businesses struggle with financing and supply issues, prices for goods will rise and availability will drop. For us as individuals, this reinforces the need for a personal emergency fund. For businesses, the message is clear. The era of easy money and endless growth is over. It's time to pivot. Focus on your core business, strengthen your financial foundations, and build a resilient operation. The companies that adapt to this new reality of credit scarcity will be the ones that survive and ultimately thrive. Thanks for watching.